So good morning everyone. So I am Herbie Aballes and we are the presenter of Group 8. So the topic was given to us is all about investment returns. So this is the learning objective. So first, we have calculate different measure of investment. Next, we have distinguish between holding and analyze returns. Next, we have compare historical performance across asset and classes. Fourth, we have differentiate theoretical historical returns from actual investor result. So the investment returns, so it measure or gain losses from securities. Historical returns help to estimate future performance at a common stock average 10% on the long term, and the short term result fluctuate widely. For example, if you invest 10,000 on stock, so the long term in a 10 years, the average of 10% yearly return, it could grow to around 25,900 pesos, and the short term in a 1 year, it might gain, if the 20% become 12,000, and the next year if you have 15%, it could fall to 10,200 in a big and downs.
The computation of return. To answer the question of what returns have been earned, it is necessary to determine how returns are computed. The simplest calculation is the holding period return, or HPR. This return is derived by dividing the gain or loss plus any income, dividends, or interest by the purchase price, that is holding period return. And these are the formula. HPR equal P1 plus D minus PO divided by P1 and PO. PO is purchase price. This is what you paid to buy one share of stock. And P1 is sale price, money you receive while holding the stock. And for D is income, dividend, interest. This is what you got when you sold the stock.
Annualized return is the average amount of money an investment earns every year. It shows how much your money grows over time using compounding. Earnings profit on both your original money and past earning. Formula: P01 plus R is equals to PN. P0 is an starting money, R is an annual return rate, N is a number of years, PN is the value of money after N years. Arithmetic average. This is a simple average of return. It just adds all returns and divides by the numbers of years. It does not include compounding, so it can give a less accurate result. Geometric average. This is the compounded average return. It shows the real growth of the investment over time. It is more accurate because it includes gains and losses. Simple example is if an investment gains 25% 1 year and loses 20% the next year. The arithmetic average is 2.5% and the geometric average is 0% accrual return. This means geometric average shows the real performance, while arithmetic average is only the simple average.
What is IRR? The internal rate of return is a financial metric that tells you the true annualized return you expect to earn on an investment. Technically, it is the discount rate that makes the total present value of all future cash inflows exactly equal to the initial cost of the investment. In simpler terms, The internal rate is the percentage return the investment actually generates over its life. So let's define each part. So we have a formula here. PO is initial investment or purchase price, or the amount you pay upfront to buy the investment. And the day 1 or day 2, or which are divided, and interest, regular money received from the investment each period, or yearly divided or bond interest. And then we have also the final value. Selling price, the amount you get when you sell the investment at the end. So, and the internal rate of return is what we solve for it. It is the known rate that balances the equations. The number of period is also year, months of and etc. So how it works? We calculate the present value of every future payment, and the final selling price, which is the then up with the total equals exactly what you paid, and the rate used is your internal rate. So we have also most accurate from the image is most accurate measure of performances, unlike simple return. An internal rate accounts for time value of money. It recognizes the money you receive later is worth less than received today. And then the reinvestment assumptions. It assumes that all money you earn is divided in interest, is reinvested immediately at the comparison tool, used to compare investment with different cash flows, patterns, or cost, and higher internal rate and better investment return. So, in short, the internal interest rate shows you the actual annual percentage yield of an investment, helping you decide if it's worth your money or better than other options.
So let's talk about reinvestment assumption. So the reinvestment assumption means that all earnings or cash flows received from an investment, such as dividends or interest, are assumed to be reinvested again at the same rate of return. So this assumption commonly used in historical return studies to calculate how investment grow over time. So it helps show the power of compounding, where money earns additional returns continuously. So, like, the table compares the different types of investment based on, so like the standard deviation of return and annual rate of return. So the standard division of return is measures like the measures of risk or volatility. So the higher percentage means the investment price change more and riskier. So the annual rate of return, like it like shows can average rarely profit earned from investment. So the data of the given is like the small company stocks, but kuan siya ng higher return at like 12.1%. Also high risk with 33.2% standard deviation, and high profit potential but very risky. So large company stocks, so ang return is 10.2%, like less risky than small company stocks. So the common choice for long-term investors is like the government and corporate bonds, lower returns around like 5 to 6%. So mas more stable and safer. like investment, like ang investment ani like ng mga treasurables is kuan, lowest risk is like 3.2%, ang lower return of 3.8%, like usually considered siya like very safe. So ang inflation is around 3.0%, like important because inflation reduces purchasing over time. So the important note of this slide is like also explains that historical returns are not always realistic, like because of like it assumes the investor nga reinvest sila all earnings and taxes are and fees is like the ignored nila. Pero ang reality ani is dividends and interest may be tax reducing like the reduce mga actual earnings. So the reinvest assumption helps investors estimate long-term growth, but actual returns may be lower because of like taxes, expenses, and changing market conditions. So higher returns usually come up with higher risks. So let's have the conclusion. So an investor's total return comes from income like dividends or interest and changes in the security selling price. So holding period return is simple but ignores time and compounding, often overstating actual gains. So like the true annualized return or internal rate of return accounts for all cash flows and time, is like giving the real compounded performance. So over time, stocks earn more than 10% annually, with small stocks offering higher returns but more risk, while bonds and treasury bills provide lower but steadier gains. So that's all for today. Thank you for watching and thank you for listening. Thank you.